Hello everybody, welcome back traders, welcome back. So it is Martin Luther King Day. The markets are closed, so very slow day, and I decided that I'm going to do a little video, a little bit more education, and also kind of set the ground rules for my new Stock Twits trading room. If you're not a member yet, head on over to Stock Twits and find the floor trader room. It's free, doesn't cost anything. I have 223 subscribers so far. And you'll see me post my various trades in here. Most of them are swing trades. I really didn't want this room to turn into a day trading room because I don't day trade that much anymore. But what I will do is lately I've been just posting some small trades and just fooling around a little bit. Nothing big, I'm not really trading with any size in the day trades, but just to kind of keep the room interesting. So if you want, but really my room is really about swing trades and kind of a medium range 1 month to 2 month hold, at worst case 3 month hold on positions. So in the room it's important that you at least understand some basic rules. The thing you're going to see right here when you come into rooms is trading is extremely risky, and risk management is the secret sauce that everyone ignores. And that's really the most important thing that you want to come and pay attention to in the room, because I'm going to be calling out several trades, but I also will scale into those trades, especially the day trading. And markets have been difficult to day trade because basically the algos are in control of the market. There's really only one time of the day that you really want to be day trading, and that is any time between 10 o'clock and 12 o'clock, because that's when the London algos are in full swing and the New York algos are just kicking in. So the London algos are finishing, the New York algos are starting. So I have a specific course that takes advantage of that. And let me just head over here. I haven't actually been really trading that London, what I call it the London push trade, because it's the end of the London day. But if you're interested, that course is $4.99. Right, and I call it the London New York algo day trading push. So day trading really has not been a great way to make a lot of money lately, and that's why I'm not doing it. Like I said, I just find that the algos are in control of the market, and it's really, really difficult unless you're trading penny stocks. And I'll touch on that topic for a second. Why don't I day trade penny stocks? Because if you are day trading penny stocks, you can do okay. But the problem with penny stocks is this. The problem with penny stocks is you need a special brokerage account, right? And accounts like Trade Zero is a good example of a special brokerage account that you need, that will get you, have you the ability to find short positions in very hard to borrow stocks. Now the problem with these companies is that it's really expensive to borrow these stocks, and they're really hard to get. So I do think day trading penny stocks is still a very profitable thing, but you have to have a special brokerage account. You can't hold them overnight because the overnight costs are insane. So yeah, anyways, that's enough of that. On top of it, good luck. Even if you have an account here, good luck getting these stocks, because they usually don't even have them. So I do think day trading penny stocks is still profitable. And I even more moderately trade some penny stocks. But anyways, that being said, you need a special account. You need to get these hard borrows. It's not as easy as it sounds, and of course you're always at risk with your your firms being at very risky offshore brokers. So I don't like to do that. Okay, so that being said, why am I making this video? Number one, I want you to understand how to scale into trades. Okay, and it's one of the things that will separate the professional trader from the amateur trader, and one of the things that retail traders do totally the opposite of institutional and professional traders. So we're going to just talk about how to do that right now. Okay, so let's just use some real life examples. All right, now I had a kind of a swing bias short on the market this month, so we'll use the spider. And you know, my fundamental reads where the market was before earnings season, my fundamental reads was the market should have been shorted. Actually, let me correct that. In all honesty, I wanted to be long the market, but with Christmas, I didn't want to hold Christmas and New Year's. I didn't want to hold any positions in calls because of theta decay, and then we got new data out on the 1st, and it was somewhat negative, but you know, so I really didn't feel like I wanted to be long, you know, in and around here, but I just couldn't do it. I just didn't want to go through the theta decay on calls. And so I'm kind of upset at myself because I did have a long bias going into the holidays. And then when we came out in the holidays, we had new data come out that I felt was somewhat bearish. But nonetheless, we've been on a full rally. So what I actually was posting in my room, you can go and see this, was I said, look at this level up here is really important, okay? I said this level here was really kind of was a level that I thought there was a lot of liquidity that was going to really make a difference between my short bias and my long bias. So I started to scale into some puts here at this point in time, and you'll see I posted that in the room. And as we got closer, I scaled in again here. Now, fortunately, I got into some puts here, and I took profits the very next day, but I scaled back in, and so now I have 2 positions underwater. And I want to kind of talk about how do I do that, okay? So the way that I look at a market is that and the way you should look at a market if you're looking to do a trade on it is something like this. Let's say you have a fundamental bias of some sort, okay? Now we'll just use a short bias because in this case that's exactly what I had. So let me just fix that. So let's say you have a short bias on the market, and okay, maybe I'll get this right eventually. You have a short bias on the market, and you know the market does what it did earlier and is going down. So this is what you're looking at. You have a short bias. Now, in this particular case, I kind of had that level up here, right? That was kind of my line in the sand, right? Now, depending on how aggressive your short bias is, you wanna kind of, let me just change this color. You want to be able to kind of say, okay, this is where I believe there's, you know, I'm wrong about my idea. Now, as the market reversed, you want to have a plan for this, okay? So, for example, my plan was something along the lines of I want to take a full-size trade if my bias was strong enough, but I don't want to commit to that trade. I want to scale into that trade, okay? So, for example, let's say that I break it up into thirds, which is what I usually would like to do. So what I'll say is, okay, between here and here, I want to break this up into thirds so that I'm not overly committed, you know, to the first level that I'm looking at. So let's say I have a level, let's say I have 3 levels. So I have a level here, I have a level here, and then I have my final level up here. Okay. So what I want to do is when I reverse my trade, I want to look for whatever it is, and I won't get into what I look for, but I want to look for you know, this level to kind of hold or not hold. and that's where I'll take my first trade. Okay. Now, if I'm wrong, I want to add to the trade. Excuse me. Forgive me. It was a bit of a cold up, very cold up here this weekend. My nasals are clogged. So I want to add to the trade as we get here. Now, if I like the trade here, I should really like the trade there. And I should love the trade by there. Now, if this is the key concept that I want you guys to understand. If you're not thinking like this, you're not thinking like a professional trader. Okay? So, if you like a trade short at this level, you should really like it here and you should love it here. Okay? And that's how you should be thinking. But you should not commit to that trade completely until the place where you know that you're wrong. So you got to have three things in place. You got to say, okay, where am I wrong above this level? I like it, I really like it, and I love it. Okay? So personally for me, the way that I swing trade is I'll take 1/3, and 1/3. Okay? So let's say my maximum risk on any trade is going to be 2% of my account. Right? My maximum risk is going to be 2% of my account. Now that's why I love to trade options. Because with options, I don't have to worry about stop losses. Right? I can use my full stop loss. Right? So let's just say on the spider, right? Hold on a second. Let's just say on the spider, I decide, and you can see here's the positions that I opened up. Now these were January 28th, okay? Only 7 days left. They're going to expire worthless, and I'm going to lose money on this trade. You can see that's the amount of money that I'm going to lose. I only lost $2,500 on this trade. That's a P&L year to date on this asset. So, you know, that is 2% of my account. It's actually 2.5%, and that was my full size. So I lost $2,500 on this particular account. Now, just so you guys are aware, I have other accounts. This is just my personal account. I do have a much larger managed account, but it's still 2.5%. Right? So what I would have done, let's say I wanted to initiate a trade right now, I would have gone, let's say, 35 days out, and I would have said, okay, I want to break that down into 2.5%. So let's just say that amount was hypothetically $2,500. Right? That's 2.5% risk for me. So what I would have done is divide that by 3. And would have risked $833 per trade. So if I was opening a position right now, if I go to buy, right, and I go to open that position, I want to say, okay, the price is, let's just say 272, right? So how many of those can I buy, right? Divided by $273. I can buy 3 of those contracts. Okay? So I'd be buying $800 worth of that contract. If the market goes higher, I'd be adding another $800. If the market goes higher, I'd be adding another $800 over the at the money. Okay? That's the way that I particularly like to do it. I do it right at the money. So if the market goes higher, I'd be adding at the money, and that would give me an average cost on that trade. Does that make sense? Okay. So that is how I would do it. I'd say, okay, 2.5%, right? And I would get in here 800. I'd get in here. I'd get in here 800. And by the time I was filled here, this is my average cost, right about there. Right? That's what my average cost is going to be on that trade. Now, if I'm wrong, okay, I'm wrong. And I lose 2.5%. As you can see, I lost $2,500 on the spider this month. Okay? No big deal. Just one trade. right? But that's the way you do it. That's how you control your risk. You have a thesis based upon your analysis. You execute the thesis based upon scaling in. Okay, now some trades are different. Okay, not all trades are built the same. Some trades are different. Okay, so for example, let's say we take a stock like FRPT. Okay, now this particular stock, I happen to love it short. Okay, so my fundamental analysis on this is for very aggressive. So my fundamental analysis on the spider was to be somewhat aggressive, but not super aggressive. On this, I'm going to handle this trade a little bit differently. Okay, because of the structure of the chart, you'll see on a 1 minute here, a daily here, this is at an all-time high. So this trade is a little bit different because this trade being at an all-time high, I have to structure it in a way that is a little safer. Okay, so what I'll usually do on a trade like this versus a trade that's in a downtrend, when I'm structuring trades that are in an uptrend, okay, something like that, I do it a little bit differently, okay? Because I want, especially if I'm really, you know, bearish on a strong uptrend, I want to handle it in a very different way. I don't want to go like 1/3, 1/3, 1/3. Okay. Because as it goes higher, that's going to be very difficult for me, right? So in this particular case, when I have something like a double top here, I'm actually going to just do 2/3 at the top if I'm retesting a level. Okay, so in this particular case, I've got a level here. I got a strong fundamental bias on it, and in this case, I'm all in 2/3 of my full size. If it does go higher, I will add the final third. Okay, so that's how I handle those trades. If you're you got to be really patient, wait for it to retest a level, and then see rejection like I saw on Monday. So in this particular case, I'm fully loaded on this trade. Okay, and I'm already fully loaded on this trade. I only took a very small position down here, but I'm very fully loaded on this trade because whenever you're trying to get a top, the probability of you trying to pick that top is very slim. It's very hard to pick tops. So when you're getting them, you have to have an insane R to R. Okay, and on top of it, you have to be really super patient. You can't scale into them as aggressively as you scale into something that's in a downtrend like that. You have to wait, see hardcore evidence that the market is doing what you think it's going to do, and then load the boat. Okay, because this is going to work a lot more often. Now it didn't work this time, right? It didn't work this time, but this is going to work about, you know, I don't want, I'm just going to exaggerate here. I don't have an exact number, but let's just say this is going to work 65% of the time when you're in a downtrend. Okay, when you're picking a top, it's going to work like small amount, like 30% of the time. So trying to pick a top, you know, I'm really good at picking tops, but you know, it's only going to work 30% of the time, and I know that. So when I do pick that top, I want to get paid, and I need to get paid big, right? So in a case like this, where it's going to work 65% of the time, I'm very happy with getting 100% return on my options. Okay, I'm very happy with getting that, because over the long run, that's going to pay me big. Now, on a trade like this, it's only going to work 30% of the time. I need much more, right? I need like a 400% return on my options to make it mathematically probable, okay? And that's exactly why I wait, look for that hardcore evidence. And on this trade, because I know over the long term, it's only going to work 30% of the time, in order for me to mathematically come out ahead, I need to get a bigger return. So I need to get in the larger portion of the trade as I'm being very, very patient. Does that make sense? Right? Where this case, I don't mind breaking it up 1/3, 1/3. This trade, I want to wait really super patiently, look to see that rejection that I saw on Friday, and then I really want to load the boat on that. You know, it's still only going to be 2% of my account, or 2.5%, right? Whichever one I decide. In this case, it was 2%, right? And I want to load the boat. Okay? So when you're scaling into trades, that's the way you do it. Now, there's one other scenario that I really want you to pay attention to that will really help you. What do you do? What do you do when you're scaling into winners? I just explained scaling into losers. Now, the opposite is true. How do you scale into winners? Now, that's the best part. Now, let's just say that I was correct, okay? And let's just say that we had this downtrend and I was right, okay? So let's say that the market, the spider, I got in 1/3 here of my puts, okay? Now, let's just say that I was right and the market went lower. Well, now I want to be able to maximize that money, and I want to scale in. So what I probably would have done is when we broke that low, I would have added 1/3. So now I'm at 2/3 size, right? Now, if the market were to come back up and go up back above that low, I would have had an average price of somewhere in here, okay? Now, let's say that it doesn't. Let's say that it continues lower. If we break this low again right here, I'm going to add that other 1/3. So now my average price is going to be right there. And the reverse would be true for longs. Okay? So now you're continuing with that trend. Your average price is what you have to pay attention to. You know, you never want to be all in, all out, unless you have a scenario where you can when you're picking a top or trying to pick off a bottom, and the potential is there for a much larger return than 100% on your option. Okay, you need like a 400% return on your option if you're in a scenario where you're trying to, what I call, be a hero. Okay? So whenever I'm trying to be a hero, right, which is trying to pick a top or pick a bottom, you really need strong percentage return. So in this particular case, I bought options that were, I believe I paid $1 and change, right? And so my target on this trade is back down here at $28. I mean, I could make 10 to 1 on my money on this trade. Now my options expire late February, so I have tons and tons of time. But there's a potential to make 10 to 1 on my money. Okay? So those are the 3 scaling in scenarios that you really want to pay attention to. How to add to trends that are moving down, how to pick tops safely and do it with risk. And again, this trade here would still only be 2% risk. Okay. In some cases, on a strong downtrend or strong uptrend, I will go as high as 3%. Okay. And that being said, you want to make sure that your portfolio is not oversized in one direction. So, for example, right now, I was heavily weighted. I was short FRPT, short Knights. I'm short Walmart. I'm short C. I'm short the SPY, but I'm actually long a very big size of WFC. And that trade hit its full target of $50 on Friday, but I had oversized skew. So, for example, let me just give you an example. I was 1.5% on Knights short. FRPT, I'm now 2%. So 3.5% short. Walmart, I actually have a spread trade on Walmart, which is 1%, right? Wait, hold on a second. So 1.5 plus FRPT 2 plus 1 on Walmart, 1%. C, I have a hedge and a short, so it's really a short. So that's a wash because I'm long C, I'm short C, and I'm long WFC on a spread trade. So that's basically a wash. So I'm 4.5% short right now total, and then I'm oversized on WFC. So I was long 2% in options WFC. So this goes -2, which brings me down to 2.5%. Nike, I now have a short position on, right? So so that's plus 1%, 1% on Nike. And JD, I'm now full size on. So that's actually plus 2% short, okay? And Cron, I am 1.5% short on. So plus 1.5 equals 7%. So the absolute worst case that could happen in my account this month, because I am using options, is 7%. Okay? Now hopefully I still have a lot of time, because most of these, with the exceptions of the Spider, are late February expiries, so I got time on these, but that's the worst thing that can happen. I'm never going to have more than a 7% loss when I'm trading options, swing trading, okay? And that's a little bit on the high side for me. I'm really not comfortable with it at 7%, but it is what it is. And you know, I usually like to stay around 5 to 8% at the very most. So this is pushing the upper boundaries. Okay. Now I won't take any more short trades, because I'm already at the upper boundaries of the maximum that I can lose for this particular month. Well, to the end of February. So really, I do it more like a quarterly, more like 2 months, not 3 months. And in extreme cases, I have to wait for my biases for a full quarter. But, you know, hopefully not. Okay, so that's how you have it. That's how you scale in the trades, right? And make sure that you never exceed more than 7. I have gone as high as 10%, you know, when I'm trading options. But never go more than 10%, right? I mean, just never do it. It's never... You never want to be in a situation where one quarter can really destroy you, right? And if you're very good at picking stocks and directions, as I am, you're not going to need to. You just won't need to, because, you know, the returns are going to be there, right? I mean, I try to average somewhere around 7% a month over the course of a year. Do I always do it? No. I mean, like, but 7% is a good year. For 7% average a month is a good year for me. 60%, 70%, that's a really good year for me. So You know, that's my goal. My goal is to shoot for 7 to 10% a month. Some months I do 22%. Some months I lose 7%. I mean, that's just the way it's gonna work, right? You're never gonna be right all the time. There's just too many moving parts. Okay, so I hope you enjoyed that video on how to scale in. The same would apply if you're day trading, which I really don't do too much anymore these days if you want to do it safely, especially if you're going to do it with penny stocks. Hope you guys enjoyed that. If you're a member of my room, this is mandatory that you understand how to do that, because don't just come in my room and just because I'm taking a trade decide it's a good trade. I don't know, guys, okay? I came to the conclusion a long time ago. Like, I'm pretty much, I'm pretty much an idiot when it comes to, trading. Right? That's my attitude. Is I look at it like, listen, I just build probabilities based upon fundamentals, based upon order flow, but I really don't know. Like, and this month I really thought, for example, the spider, I was really shocked. I mean, I'm really surprised it went this high. I thought 258 at the worst would hold. It didn't. I was wrong. I'm wrong, right? I lose 2.5% of my account. I live to fight another day, right? It's not a big deal. Okay, whether you're day trading, whether you're swing trading, the same concepts apply. If you're doing anything else other than that, trust me, you will blow your account. How do I know? Because I've done that multiple times. It took me a long time to learn to stick to these rules. Okay? And it took me a very long time to learn about myself enough to understand that I need to structure my trading based around my personality, my strengths, my weakness. And that's one of the main reasons why now I'm pretty much exclusively trading options. I'm not even day trading anymore, because it's just perfect for my personality, right? I'm not good at adapting on the fly, right? I'm good at coming up with a big picture idea, and then that big picture, I don't know how long that big picture is going to take to play out. Most of the things that I think are going to happen, I think happen about 80% of the time. I'm not exaggerating. 80% of the time, I will get the big picture right. But, when and exactly how that happens, that is the secret sauce that I don't know, right? But I know I'm going to be right 80% of the time as far as the bigger picture is concerned. But how and when exactly? That is and that's why you want to scale into positions. Does that make sense? And that's why you want to use assets, for example, like options, because it will limit my risk, right? And then there's situations like, like Tesaro, where, I'm completely wrong. I mean, I was short this thing. I could have got destroyed, but because I was in options, no big deal. Like this one was a little bit more expensive than I wanted it to be. This one, I think I lost 5% on this particular trade, but it didn't blow my account. Back in the day when I was younger and I was foolish, I might have shorted that stock, and that would have blown an account. And it's happened to me before in the past, where I've had major 30%, 40% drawdowns, because I'm not very good at adapting on the fly. This stock, when I started shorting it, it showed clear signs of buying. But at least I had the sensibility to stop day trading it, flip to options, and go for my longer term thesis, right? And that's what I did. Okay? And you got to learn yourself. You got to learn your strengths, your weaknesses, and you got to learn why you scale into positions. Okay? In this particular case, I started shorting it here. I added to the trade here, and I added to the trade. I was in full size on that trade. But I started here, added here, and added here. And it was brutal, right? It was a big loss. That was a 5% loss to me. It was really painful. But back in the day, you know, that trade would have blown an account on me easily, right? So again, you learn your strengths, you learn what you're good at, you learn your weaknesses, and you adapt your style of trading. You don't want to be adapting on the fly, because it's really hard to do that, especially when we have cognitive biases, especially if you have a personality that, especially if you're like me, where I'm 80% right. Like I said, I'm 80% right, and so when I'm wrong, it's really hard for me to accept that. Does that make sense to you? Because, but that 20% that I'm wrong will blow your account. Even if you're as good as I am, 80% of the time you're right. That 20% of the time when that happens, if you don't scale into trades, and if you don't put yourself in some type of trade, for example, like options, right, you're going to get your ass handed to you. Right? Does that make sense? So the bottom line is, if you're losing money, scale into trades. If you're losing money, never overcommit more than 2 to 3% of your account on any one trade. If you're losing money, learn how to read big pictures. If you're losing money, follow this money management. Okay, I teach a far more effective money management in my course that's based around Kelly Criterion, but this is just a big picture idea. I'm doing this for you guys in the room. Hopefully you enjoyed that video, and hopefully you will learn from my mistakes, and hopefully you will understand that I didn't get to where I am 40 years later by mistake, guys. I learned it not because I'm a genius, because I'm really not, but I learned it through hard knocks, right? And that's what, if you want to learn a shortcut how to not make those mistakes, then reach out, take my course. Bye for now.